$38 trillion. That is the current size of U.S. government debt. It is a number repeated so often that it has almost lost its meaning. Too large to picture, too abstract to feel immediate. Yet this single figure now sits at the center of global finance, shaping government budgets, bond markets, and monetary policy worldwide. Before discussing reactions, interpretations, or future outcomes, we need to understand one thing clearly: what this debt actually represents, how it reached this scale, and why this number can no longer be treated as just another headline. Let's begin with the debt itself. The number itself is almost impossible to visualize. $38 trillion. That is the size of the United States national debt today, larger than the entire annual economic output of the country, larger than the combined GDP of China, Germany, Japan, and India, and still growing. By itself, that figure is often used as a shock headline, but numbers like this only become meaningful when placed in context. Debt, on its own, does not collapse economies. What matters is how it grows, why it grows, and whether the system built around it can continue to function. To understand why this number has become so central to today's economic anxiety, we need to step back and look at how the United States arrived here. At the end of World War II, US government debt exceeded 120% of GDP, a level comparable to where it stands today. But the structure of that debt was fundamentally different. Interest rates were capped, capital controls were in place, the United States was the world's dominant industrial power, and global demand for dollars was rising, not falling. Over the following decades, that debt did not disappear. It was diluted. Inflation reduced its real value. Economic growth expanded the tax base. A rapidly growing population increased productive capacity. Debt was not eliminated. It was absorbed. The modern debt problem is different. Since the early 1980s, the US economy has become increasingly financialized. Growth has relied less on productivity gains and more on credit expansion. Each recession has been met with lower interest rates, larger deficits, and more aggressive monetary intervention. Every crisis has been solved by pulling future growth into the present. This worked until the scale itself became the constraint. Between 2008 and 2020, US federal debt nearly doubled. Then came the pandemic. In just 2 years, deficits measured not in billions, but in trillions, became normalized. Emergency measures quietly turned into structural features of the system. By 2024, interest payments on US debt exceeded $1 trillion annually, more than the defense budget and larger than most federal agencies combined. Unlike social spending or infrastructure investment, interest payments produce no economic output. They are purely the cost of maintaining the existing structure. This is where the character of the problem changes. As debt grows faster than economic output, refinancing becomes more important than repayment. The system no longer depends on reducing obligations, but on rolling them forward continuously. That requires stable demand for government bonds and confidence that inflation will not erode returns too aggressively. For decades, that confidence was taken for granted. U.S. Treasuries were considered the risk-free asset. They were liquid, deep, and supported by the world's reserve currency. Central banks held them not because they offered high returns, but because they anchored the global financial system. But rising debt alters that balance. As issuance increases, the market must absorb more duration risk. As interest rates rise, the cost of servicing old debt increases. And as deficits persist during periods of economic expansion, not recession, the room for countercyclical policy narrows. This does not mean default is imminent, it means flexibility is declining. The US government does not face a liquidity constraint in its own currency. It can always issue dollars. But issuing currency does not eliminate real economic trade-offs. It shifts them slowly and often invisibly into inflation, asset prices, and distributional stress. This is why the debt conversation has returned so forcefully. Not because markets expect collapse tomorrow, but because they recognize a familiar historical pattern. When obligations grow faster than productive capacity, systems begin searching for nonlinear adjustments. And those adjustments rarely appear where people expect them. In the past, excessive debt in advanced economies has not resolved through dramatic defaults. It is resolved through repression, inflation, financial engineering, and changes in the structure of assets and liabilities. The rules evolve not overnight, but under pressure. The key point is this: the size of the debt alone does not determine the outcome. What matters is whether the economic base beneath it can continue to generate enough cash flow to sustain confidence. And that question is no longer abstract. Beneath national averages and headline growth numbers, the US economy is not a single machine. It is a network of regional systems, industries, and balance sheets, many of which are already under strain. The debt problem is not isolated at the federal level. It echoes through households, businesses, local governments, and financial institutions. Stress in one part of the system does not remain contained for long. History shows that large debt structures rarely fail from the top down. They weaken from the inside out. Which is why, to understand the risk embedded in this $38 trillion figure, we need to look beyond Washington, beyond policy debates, and into the real economy itself, where cash flows are tightening, margins are shrinking, and leverage is becoming harder to carry. That is where the next cracks begin to form. When people talk about the US economy, they often speak as if it were a single entity. One balance sheet, one trajectory, one outcome. But in reality, the American economy is a collection of 50 distinct systems tied together by finance, trade, and federal policy, yet moving at very different speeds. And while national GDP figures continue to show growth, those averages are masking a growing divergence beneath the surface. Over the past 2 years, fewer than half of US states have experienced meaningful real economic expansion. A significant number have stagnated, and more than 20 have seen outright contraction in key sectors. These are not temporary fluctuations. They are structural pressures building simultaneously across multiple layers of the economy. The first cracks appear in industries that once formed the backbone of American economic stability. Manufacturing is one of them. For much of the 20th century, manufacturing anchored middle-class income, regional employment, and productivity growth. But over time, its share of the economy has steadily declined. In the 1960s, manufacturing accounted for roughly a quarter of US GDP. By the 1990s, that figure had fallen to around 15%. Today, it sits near 10%, employing less than 8% of the workforce. This decline was not accidental. It was the result of globalization, technological change, and a deliberate shift towards services and finance. For decades, cheaper imports and global supply chains lowered consumer prices and boosted corporate margins. The trade-off was geographic concentration of losses, particularly in the Midwest and the industrial heartland. In theory, this transition was sustainable, as long as displaced labor could move into higher value sectors. In practice, that transition has been uneven and incomplete. Recent policy efforts to reverse industrial decline through tariffs and supply chain reshoring have produced mixed results at best. Manufacturing depends on two fundamental inputs: labor and materials. The United States faces structural disadvantages in both. Labor costs remain significantly higher than in export-driven manufacturing economies, and while the US benefits from advanced logistics and infrastructure, tariffs have raised the cost of imported components, eroding the competitive advantages that remained. As a result, manufacturing output has contracted for consecutive months. Job losses have reappeared in regions that were already economically fragile. Plants are operating below capacity. Capital investment has slowed, and margins are being compressed by higher financing costs. These pressures do not stay confined to factory floors. As manufacturing weakens, its effects spread outward into transportation, construction, and local services. Municipal tax bases shrink, household incomes become less predictable, and debt servicing becomes harder. Agriculture, another foundational sector, is experiencing a similar pattern. Midwestern states rely heavily on agricultural output not just for income, but for export revenues and financial stability. Yet over the past 2 years, global crop prices have fallen sharply. Increased production in countries with lower labor costs has flooded international markets, pushing US producers into a price war they are structurally ill-equipped to win. Trade policy has amplified these pressures. Retaliatory tariffs have reduced access to key export markets, particularly in Asia. For some crops, major buyers disappeared almost overnight. At the same time, labor shortages have intensified, Agriculture has long depended on migrant labor to perform physically demanding work that domestic labor markets have been unwilling to supply at scale. Stricter immigration enforcement has reduced that workforce, leaving crops unharvested and operations running below capacity. The financial consequences are severe. Farm bankruptcies have risen sharply in several states. Net farm income has declined by double-digit percentages since 2023, and futures contracts, once a stabilizing tool, have become a source of additional stress. These contracts lock in prices and quantities. When labor shortages prevent delivery, farmers still face margin calls and financial penalties. The total value of agricultural futures contracts has fallen by more than 20% since 2022, triggering cash demands that many producers cannot meet. When farms fail, their debts do not disappear. They are transferred upward to regional banks, credit unions, and insurers that finance equipment, land, and operating costs. These institutions often lack the diversification and capital buffers of national banks. This is how localized stress becomes systemic risk. At the household level, similar dynamics are unfolding. For nearly a decade, ultra-low interest rates encourage borrowing across income groups. Mortgages, auto loans, credit cards, and buy now, pay later programs expanded rapidly. In many states, household debt-to-income ratios now exceed 130%. When rates rose, the adjustment was immediate. Monthly payments increased. Refinancing options disappeared. Delinquencies on credit cards and auto loans climbed to their highest levels in over a decade. In states with weaker social safety nets, households relied more heavily on debt to smooth income volatility, making them especially vulnerable when conditions tightened. Small businesses are feeling the same pressure. Higher borrowing costs have raised the threshold for profitability. Defaults are rising. Commercial real estate vacancies have increased, particularly in secondary cities and suburban markets. Together, these pressures form a pattern. The US economy is not collapsing uniformly. Growth remains concentrated in a narrow set of sectors and regions, particularly those tied to technology and artificial intelligence. But outside of those hubs, cash flows are weakening. Leverage is harder to sustain. And resilience is declining. This matters because debt is not serviced by averages. It is serviced by cash flow. When enough parts of the system begin struggling simultaneously, the margin for error shrinks. Shocks that would once have been absorbed now propagate. What begins as sector-specific weakness can cascade through credit markets, labor markets, and financial institutions. Historically, this is the stage where confidence becomes conditional, not broken but no longer automatic. And when confidence begins to depend on conditions rather than assumptions, capital behavior changes. Investors become more selective. Lenders tighten standards. Reserve managers reassess exposure. These shifts do not appear in headlines at first. They appear in allocation decisions, which is why, to understand how the world is responding to America's growing debt burden, the next step is not to look at speeches or policy promises, but to look at where global capital is quietly moving. When economic stress builds inside a system, the first visible reactions rarely come from politicians or central banks. They come from capital. Capital does not debate, it reallocates. And over the past several years, global capital has been sending increasingly clear signals about how it perceives the trajectory of U.S. debt, policy, and the long-term purchasing power of the dollar. The most important signal is not found in headlines. It is found in the quiet behavior of sovereign balance sheets. For decades, U.S. Treasury bonds were considered the safest asset in the world. They were liquid, deep, and backed by the largest economy on earth. Foreign governments accumulated them not only for yield, but for stability. At their peak, foreign holders owned more than one-third of all marketable U.S. Treasuries, equivalent to over $7 trillion. That relationship is changing. Over the past several years, foreign demand for U.S. Treasuries has stagnated and, in some cases, reversed. Major reserve holding nations have either slowed purchases or actively reduced exposure. China alone has reduced its Treasury holdings by over $100 billion since 2022, continuing a longer decline from more than $1.1 trillion in 2017 to under $700 billion today. Russia has almost entirely exited the dollar system following sanctions. Japan, still the largest foreign holder, has seen its Treasury holdings remain largely flat despite rising U.S. issuance. Other countries have not sold aggressively, but they have stopped adding. This distinction matters. A slow withdrawal does not trigger panic. It avoids headlines, but it fundamentally alters the marginal buyer of U.S. debt. When foreign central banks step back, someone else must step forward. Increasingly, that buyer is domestic institutions or the Federal Reserve itself. Since 2020, the Federal Reserve has absorbed trillions of dollars in U.S. Treasuries through balance sheet expansion, becoming one of the largest holders of government debt. Even as quantitative tightening officially continues, the system remains structurally dependent on domestic absorption. At the same time, the composition of global reserves is shifting. Central banks are buying gold at the fastest pace in modern history. According to the World Gold Council, official sector gold purchases exceeded 1,000 metric tons in 2022, remained above 1,000 tons in 2023, and stayed historically elevated through 2024 and into 2025 levels not seen since the collapse of the Bretton Woods system. This is not isolated behavior. By the end of 2025, China's central bank was holding more than 2,300 metric tons of gold. India had added over 100 tons to its reserves. Turkey had increased its gold holdings to above 600 tons. Middle Eastern sovereigns, including Saudi-linked institutions, have increased exposure as well. Even European central banks, traditionally conservative, have largely stopped selling gold, reversing a decades-long trend. Taken together, these purchases represent a coordinated shift across geopolitical blocks. These are not speculative trades. Central banks do not buy gold for momentum or short-term returns. They buy it for neutrality. Gold carries no counterparty risk. It is not issued by any government. It cannot be frozen, sanctioned, or diluted by fiscal decisions. When reserve managers increase gold allocations, they are not betting against growth. They are hedging against monetary uncertainty. At the same time, something equally important is happening on the other side of the ledger. Global dollar reserves are no longer growing. According to IMF COFA data, the US dollar's share of global foreign exchange reserves has declined from over 70% in the early 2000s to around 58% today. More importantly, the absolute level of dollar reserves has flattened, even as global trade and debt issuance continue to grow. This signals not rejection but saturation. Countries are not dumping dollars. They are choosing not to accumulate more. Meanwhile, the global payment system is fragmenting. More trade is being settled in local currencies. Bilateral agreements increasingly bypass the dollar. Regional payment systems are being built specifically to reduce reliance on US-centric financial infrastructure. This process is often described as de-dollarization, but that term is misleading. It implies a sudden replacement of the dollar. What is actually happening is slower, quieter, and more practical. Countries are reducing marginal dependence. They are not abandoning the dollar. They are preparing for a world in which the dollar is less dominant, less trusted, and less essential to global trade. Energy markets illustrate this shift clearly. For decades, the dollar's reserve status was reinforced by oil. Energy trade required dollar settlement, creating constant global demand for US currency. That mechanism is weakening. Electric vehicle adoption is accelerating. Oil demand growth is slowing. And energy exporters are increasingly open to accepting alternative settlement currencies. When fewer dollars are required for trade, more dollars remain idle or return home. This is a critical point. For much of the past 50 years, the United States exported inflation by exporting dollars. Excess liquidity flowed abroad and stayed abroad. As global demand for dollars weakens, that buffer erodes. Dollars come back. When they do, they expand the domestic money supply without a single new policy decision. This amplifies the inflationary impact of any debt monetization at home. Global investors understand this dynamic, even if it is rarely discussed openly. That is why portfolio allocation has gradually shifted away from long-duration sovereign debt and toward assets perceived as scarce or politically neutral. Gold is one. Certain commodities are another. And increasingly, a new category has entered the conversation: Bitcoin. Not as a reserve currency, not as a replacement for the dollar, but as a hedge outside the traditional financial system. Since 2020, Bitcoin has been increasingly held by institutional investors, sovereign-linked funds, and publicly listed companies. Its fixed supply, censorship resistance, and independence from monetary policy place it in the same conceptual bucket as gold, but in digital form. This does not mean it is stable. It is volatile. It is speculative. But the fact that it is being discussed at all by institutions that once dismissed it entirely is itself a signal. It reflects the same underlying concern. What happens when debt continues to grow, but confidence quietly erodes? What matters here is not ideology. It is risk management. From the perspective of global capital, the question is no longer whether the United States can technically service its debt. It can. The question is what form that servicing will take. Will it be paid in dollars with the same purchasing power, or in dollars that have been structurally diluted over time? So far, the response has been cautious, not confrontational. There has been no coordinated dumping of treasuries, no sudden bond market collapse, no explicit declaration of lost confidence. Instead, there has been a quiet rebalancing, less marginal buying of US debt, more accumulation of hard reserves, more optionality. This matters because confidence in financial systems rarely disappears overnight. It erodes gradually and then suddenly. Historically, the most dangerous phase is not panic. It is complacency. When markets continue functioning normally, even as underlying assumptions weaken, participants assume stability is permanent. But stability built on belief rather than balance eventually reaches a limit. At that point, reactions accelerate. The world does not need the United States to default to respond to its debt problem. It only needs to believe that repayment will come in depreciated terms, and that belief is already shaping behavior. Which leads to the final and most sensitive question. If the debt burden is growing, internal cracks are spreading, and global confidence is quietly being hedged, why does the system still appear calm? Why has there been no crisis? Why do markets continue to function as if everything is under control? The answer is not found in balance sheets. It is found in narrative, and in the growing belief that somewhere, behind closed doors, a sophisticated plan already exists. That belief, whether true or not, is what we turn to next. Every financial cycle does not collapse because of numbers. It collapses because of belief. Not belief in a religious sense, but belief in a story that once worked, once saved the system, and therefore must work again. In moments of systemic stress, markets do not search for truth. They search for comfort, and comfort always comes in the form of a narrative. The most powerful narrative of the modern financial era is simple and familiar. The system is stressed, but it is under control. Liquidity will return. Institutions are prepared. This time is different. This narrative has been repeated at every major inflection point of the last half-century. In the 1970s during stagflation, in 1987 after Black Monday, in 1998 during the LTCM crisis, in 2000 after the dot-com collapse, in 2008 during the global financial crisis, in 2020 during the pandemic shutdown, and each time the narrative worked, until it didn't. Because narratives are not lies, they are delayed truths. What makes the current moment dangerous is not that the narrative is wrong, but that it is incomplete. The dominant story today tells us that inflation has peaked, that rate hikes are nearing their end, that growth will slow but not break, and that the Federal Reserve will eventually engineer a soft landing. Markets want to believe this because they must. Asset prices are no longer priced on productivity or long-term cash flows. They are priced on expectations of policy reaction. Equities rally not when earnings improve, but when yields fall. Crypto rallies not when adoption rises, but when liquidity expectations increase. Gold moves not on inflation headlines, but on confidence in the monetary regime. This is not speculation. This is observable behavior. Yet the narrative avoids addressing the structural constraint now facing the system. There is no longer excess credibility to deploy. In previous cycles, central banks had room to act. Balance sheets were cleaner. Debt to GDP ratios were manageable. Demographics were favorable. Globalization was deflationary. And trust in institutions was intact. Today, none of these conditions exist. Public debt across developed economies stands at historic highs relative to output. Aging populations reduce labor force growth while increasing fiscal burdens. Global supply chains are fragmenting rather than integrating. and political polarization is eroding consensus around economic sacrifice. The narrative claims that policy tools remain effective, but effectiveness depends not on availability, it depends on acceptance. Rate cuts only stimulate if they are believed to be temporary and reversible. Liquidity injections only stabilize markets if they do not threaten currency credibility. Fiscal expansion only works if bond buyers trust the issuer. At this stage of the cycle, trust is the scarce asset. This is why gold behaves differently now than in previous inflationary episodes. It does not rally purely on price pressure. It rallies quietly, steadily, without euphoria, as a hedge against narrative failure. And this is also why Bitcoin occupies such a controversial psychological space. Bitcoin is not threatening because it replaces fiat currency. It is threatening because it exposes the fragility of belief-based systems. Its supply cannot be adjusted to match political necessity. Its issuance does not respond to unemployment data or election cycles. Its credibility does not depend on forward guidance. For institutions built on discretion and flexibility, this rigidity is uncomfortable. As a result, Bitcoin is framed not as a monetary alternative, but as a speculative asset, a narrative containment strategy rather than an analytical conclusion. The same pattern appears in discussions of gold. Official discourse treats it as a legacy asset, historically important but economically irrelevant. Yet central banks continue accumulating it at the fastest pace in decades. This contradiction is not accidental. Gold is excluded from the narrative because acknowledging its role would require acknowledging limits to fiat credibility, and acknowledging limits breaks the spell. Narratives are not designed to explain reality. They are designed to maintain coherence. The coherence being maintained today is the belief that the existing monetary architecture can absorb unlimited stress without fundamental adjustment. History suggests otherwise. Every major monetary reset begins not with collapse, but with denial. Not with panic, but with reassurance. Not with sudden failure, but with a gradual mismatch between story and experience. When everyday reality diverges too far from the official explanation, trust does not disappear overnight. It migrates. It migrates into assets that do not require belief, into systems that do not promise stability but enforce rules, into stores of value that do not speak but persist. This is why the question of gold and Bitcoin is not about price targets or adoption curves. It is about narrative exhaustion. The current system does not fail because it runs out of tools. It fails when its explanations no longer convince those who are asked to bear the cost. The most dangerous moment in any cycle is not the crash. It is the calm that precedes acknowledgement. Because during that calm, capital reallocates silently, risk is repriced quietly, and history shifts direction without headlines. The narrative everyone wants to believe is that adjustment can be postponed indefinitely. History suggests adjustment is inevitable. Only the form and timing remain uncertain. And that uncertainty is precisely what defines the transition phase. Not panic, not collapse, but the slow realization that the story has changed, even if the language has not.